Have you ever wondered what it takes to become a full-time LP or how to vet syndications in a volatile market? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're learning from someone who's done over 100 syndications and has lived to tell the tale. I'm your host, Pascal Wagner, and today I'm joined by Jim Pfeifer, the new host of the Passive Pockets podcast and former founder of the Left Field Investors, which is now part of the BiggerPockets brand. And Jim started his journey as a high school teacher, then eventually a financial advisor, before building this thriving community of left field investors and becoming one himself. So if you're trying to build wealth through passive investing, avoid rookie mistakes, or navigate the next 3 to 5 years of market changes with more confidence, this episode is packed with lessons from someone who's been in your shoes. Welcome, Jim.
Thank you. Thanks for having me. Glad to be here.
Yeah, I'm excited. So I had the great opportunity of meeting Jim at the Best Ever conference this year, and it's just been great to kind of meet you in person after following you online for quite a while. We were just at that conference together. It happened less than a month ago. I'd love to dive in before we get into your story and talk about how you became a passive investor, what problems it solves, and then eventually talking about the differences between passive investing and stock market investing. What do you think were your biggest takeaways from this year's Best Ever conference?
I think it's similar to other years in that it's just the biggest takeaway is relationships, right? Like we got to know each other there. And it just makes a huge difference in investing or in anything if you can shake someone's hand and have a conversation face to face. It's great that we can get on Zoom and have virtual calls or get on the phone and all that, but just meeting someone in front of them and sharing time and space with them, I think makes a huge difference. Having a drink or just, having a meal with somebody, it really makes a difference. So it's generally the takeaways I get from that conference as an LP is I get to meet the operators, right? That's why I go there. I wish there were more LPs there, and every year I think a few more show up, but it's really about what happens in the hallways. And it's cliche to say you go to this thing and there's great speakers, but you miss a lot of the speakers because you want to be networking in the hallway. But that's really where relationships are made. And so for me, the takeaway this year was definitely just re-solidifying relationships I already had and making new ones.
Yeah, I definitely resonate with that. I think you see a lot of these names online, and you might go to some of their webinars or anything like that. Um, but there's just a new layer of trust that you kind of get by being there. So I resonate with that. I think that's a great takeaway. I'd love to dive in, for everyone that's listening, I think one of my favorite things that I like to do is bring on quote unquote successful LP investors, like people who have, retired, semi-retired off of passive investing, which is kind of ultimately the dream, right? And I'd love to start out with you sharing a little bit of your story of how you got into passive investing. You took a journey through financial advising. There's a couple things as part of that journey that I'd love to dig into, but I'd love for you to kind of just give us a little bit of your story and how you got here.
Yeah, I think I mentioned when we were off air here, I'm on career number 6 maybe, and I studied finance in college, and that was always my passion. I just wanted to be doing something in finance. And so as soon as I got my first job, which was just a business job doing reinsurance underwriting before I became a teacher, I was so excited to put money into my 401k. So I just immediately, as soon as they'd let me, like 6 months, I had to work there 6 months, and I started, putting the max in my 401k. I started getting the newsletters to invest in mutual funds and things like that. And I was just really into it because I was convinced that the way to build wealth was to invest in the stock market, right? That's how you build wealth. And so that carried me for the first, 10 or 12 years of my career. And, I realized that it wasn't working, but I still thought, well, it's just the only way. And, then I became a teacher, and we or tried to sell a house and couldn't. And so I became an accidental landlord. And that was kind of dipping my toe into real estate. And then teaching was super hard. I taught high school finance and accounting in Columbus City schools, and it was a challenge. I mean, the kids were great, but teaching is hard. And so I decided, I wanted to be a financial advisor because I could still teach, but I could do it about money to adults who wanted to learn, I thought. But the funny thing is when you become a financial advisor, they teach you about money like you know nothing. And at the same time, I was seeing the results of real estate through this accidental landlord situation I had. And so they were teaching me about money and I was applying it to real estate. And so I was a financial advisor for about 7 years, but during the whole time I was a financial advisor, I was slowly moving more and more towards real estate because I was learning that paper assets don't have a current benefit. So it's basically speculation, right? You're buying a piece of paper, electronic piece of paper now, and holding it and hoping that at some point later you can sell it to somebody else for more than you bought it, right? That's it. Where I had this real estate, I was building a real estate portfolio and I noticed, wow, I'm investing in something that has a current benefit that's cash flow. And then maybe I'll get some appreciation on the back end, but the cash flow is what's sustaining me. And so that showed me that's investing. And the stock market was speculation. So I was a financial advisor and I transitioned because I realized that I prided myself in putting my clients into the same things I was getting into, but I wasn't into the paper assets anymore. I mean, I still did a few that made sense, but I was more into real estate and I couldn't put my clients to real estate. So that's when I went fully active into real estate. Now, at this time, I was buying turnkey single family homes and some small multis. I ended up buying a 22 unit and I called myself a passive real estate investor because I had property managers to manage the assets. They weren't all in my, city or state. I hadn't even seen some of them. So I was passive. What I realize now is that I wasn't passive. I was an active real estate investor who happened to hire property managers. I was still the asset manager. And that's a full-time job, right? And I wasn't very good at it. But fortunately, I did it in a period of time where, I got the appreciation. I didn't get the cash flow that I talked about that I liked, but I got the appreciation. And then I stumbled into this thing called syndications. And that's where I was like, this is me. Right now, I hire an asset manager, somebody who their full-time job is to manage whatever property that I decide to invest in. And I do all the work beforehand. There's a lot of stuff to do. It's not passive until you send the wire, but then it's passive. And that worked to my skill set. And that's when I realized, oh, I was active this whole time, but this passive thing, that's for me. And that's when, we started Left Field Investors and build a community that turned into Passive Pocket.
You and I have a very similar kind of thought process or story. I think very much of like w- I also own a portfolio of real estate, and very much you realize it's not passive, and especially as you grow it, the problems also grow.
Yes, they
But this
do.
idea of investing for cash flow and appreciation being the bonus, whereas I think many people who get into real estate, they primarily think about, it doesn't matter if it cash flows, if it breaks even, I'm betting on the appreciation, which I think is completely backwards. How
I
have
agree.
you dealt when you think about, now, I'd love to dig into more of the financial advising part of your career because I think that part is incredibly fascinating. I had a very similar part in my story where after my dad passed away and I had to figure out how to deploy a bunch of money to help my mom retire. I reached out to many, at least 4 financial advisors, and all of them were focused on the stock market and nothing that could really provide cash flow. If anything, it was like dividend funds.
Yep, absolutely.
And so I'd love to kind of dig in to that part of your career to just like give insight to the audience of like, why is it taught that way? What are the pros, cons, repercussions? Yeah.
Yeah, it's really pretty easy. Financial advisors are trained by the companies that they work for, and they sell the products that the companies offer, right? And so financial advisors generally aren't nefarious and trying to steal your money or anything like that or keep you out of real estate because it's bad. They just don't understand it. They're not licensed for it and they don't get compensated for it. And guess what? Humans tend to focus on things that get them something, right? They're compensated a certain way, so they sell those products. They're trained a certain way, so they sell those products. So what you need to do when you're looking for a financial advisor, in my opinion, is find one that understands real estate and is okay with you putting money into real estate because what happens is not only are they not licensed, so they can't recommend it, they don't get compensated. But if you have $1 million in your portfolio and you say, hey, I want to put a $500,000 in real estate, they're going to say, oh, no, don't do that because one, it's risky because they don't understand it. Two, they won't get compensated. But three, you're taking income away from them, right? Because that $500,000 is going to go outside of their management and then they don't make money from it. So it's not purposeful, but they're not trained to understand real estate or invest in real estate. So what I do is just like I use my community for everything, right? If I want a financial advisor, I go talk to my other people in my community and say, hey, do you have a financial advisor that is a real estate investor, understands real estate, and can incorporate my real estate into the financial modeling that they do? It's the same with a CPA. I look for someone who's in real estate. So I think it's interesting when you look at financial advisors because it is partially a lot of them that I met and worked with, they want to do what's best for their client. They really do. They also want to make money, but those compete with each other sometimes. And also, what they think is best for their client might not be because they don't understand there's a whole world outside of that. Now, there's some, family office type financial advisors who do have access to real estate investments and do put their clients in real estate, but it's still probably a lesser portion than most passive investors would want. When I first started, one of the errors I made when I first got into passive investment syndications is I went all in, right? I became very illiquid and didn't, and was like, I hate the paper assets. I want nothing to do with it. And since then, I've realized there is a place for that in my portfolio, but it's a very small percentage. And a financial advisor, they might say, okay, put 10% in something risky like real estate, where I'm the opposite. I'm like, I'll put 10% maybe in something risky like speculating on paper assets. So I don't blame the financial advisors. They just don't have the knowledge or the education. And the company is, putting quotas on them saying, hey, you got to sell 10 of these and 5 of these, and none of those are real estate.
How does a company go about finding the products that it kind of arranges for their financial advisors to recommend?
It really depends on the company. There's lots of different models and lots of different ways of doing it. But they push the companies push the products that will make them the most money. And then the advisors often, look at, well, I can push product A or product B. They both do basically the same thing, maybe, or they're similar and they're both okay or good for the client. Well, which one are you going to push? The one that pays you the most, right? And so, but I don't believe that the solution to that is to avoid commissioned advisors or think, some people say just, pay a fee and then they recommend you're still going to pay fees to these either the advisor or to the products that they put you in. There's always going to be fees, right? There's fees for everything. So fees aren't the bad thing here. It's that they don't teach about real estate and they don't recognize that the tax breaks. Everyone is so focused on retirement and the 401k and how do you find extra money from your mortgage and this and that so we can put it into more of these financial products. Well, all these financial products are engineered in different ways and they're super complicated. And so even the advisor doesn't always understand all of the things that are wrapped up in there. And so it just becomes this real confusing world. And some of it, you can make money on it, right? That's not a bad thing to be talking to your financial advisor. They probably know more about it than you do. But think about the wealthy people that you know in your life or you know of. I would bet none of them have created their wealth through investing in the stock market, right? They either buy businesses like Warren Buffett does, or they invest in real estate. That's how you get wealthy. Now you can make good money and your W-2 job and put it in the stock market and do fine, but you're not creating wealth like real estate investors do. And so I think that's what people need to recognize is there's this huge machine, right? You turn on the TV to any sporting event, you're going to get a ton of financial companies advertising. You're not going to get any real estate syndicators advertising or anybody saying, hey, go buy real estate, right? It's just this scary, complicated thing. It's alternative investments, right? You have standard Wall Street investments that if you walk out your front door right now and say, hey, neighbors, let's talk about personal finance, every single one of them, IRA, 401k, interest rate on my mortgage. And then you're going to come in and say, do you want to talk about investing in real estate? And they're going to be like, ooh, that's scary. And then you're going to say the even scarier word, syndications. And then you're going to turn around and they're all gone because the weirdo's talking about real estate syndications again, right? But they don't realize that's the way to create wealth. But it's scary, right? It's hard to find these investments. Where do you find syndication investments? You have to wire money to somebody you've never met, right? There's all kinds of obstacles in the way where when you go get a job, right? After 6 months, they say, hey, do you want to put money in this 401k? And the old guy who's been there for 30 years says, yep, that's what I did. Look at me. I'm going to retire next year. And you're like, okay. right? Then you're in the 4K and then you're on your way. But it's real estate is for people who want to look outside of the normal and find a better way. And it's hard.
Well, I also don't know of any other way to create meaningful cash flow. I mean, you can, you know, I've watched my dad invest in dividend stocks and, only to have those things yield maybe 5 or 9%. And then, the volatility of the stock market, he would, a year
Right.
later, the stock would be worth less.
The biggest problem with that strategy, right, is let's say it pays 9% dividends. Maybe you can get a whole portfolio of 9% dividend. That's fantastic, right? That might beat the preferred return you get on a real estate investment, but you're paying taxes on it, right? The biggest eroder of wealth and the biggest place you can get free cash flow is by reducing the amount of tax you pay legally, right? And what's the best way to reduce your taxes? By investing in real estate, syndication real estate. You can do, even though bonus depreciation is going down, maybe it'll come back, but it's decreasing. Still, there's such significant tax benefits that the cash flow that you get, the 7% you might get on a syndication deal, that's basically tax free. You're not paying tax on that. Where the 9%, if you're lucky to get it, but probably more like 3 or 5% on dividend stocks, you're still paying 25 or 30% tax on that. So it's not even comparable.
Yeah, when you think about, I think a lot about mentors, right? I always want to learn from people who are several steps ahead or have achieved what I want to achieve versus maybe talking to an advisor. And so, I'd love to get your take on that concept versus talking to a financial advisor who may not have achieved, in many cases, I'm sure haven't achieved what some of their clients where they're at, even though they study on how to be a financial advisor, and I'm sure they have a good understanding of the products and stuff out there. But I always thought that was like a weird dynamic. How do
Yeah,
you
I
view
love
that?
that. I love that question because the first thing my mother always says when she meets a financial advisor is, "Why are you still working? If you're so good with money, why are you still working?" And if you look at these financial advisors, they never quit. Why? Because they're like house flippers. They don't have recurring revenue, a lot of them. And once they stop advising, all that money goes away. So they have to keep going. So that's a great question, is why isn't don't they believe in cash flow? I don't know. They just don't understand it, I think. And so I think that question, when my mom asks it, it always cracks me up because it's legit, right? Why are they still advising? Do they just love it so much? Maybe they do, but they also have to because that's where they get their income.
Yeah, absolutely, absolutely. We are also getting comments from people who are live here on the show saying they love that note. So I'd love to kind of take so thanks for covering on that. I've always kind of been intrigued on the financial advisor route. Can you take us back to? I'd love to maybe get into the story of your first passive investment and maybe when you could realize this could be more than just a side hustle. What was that deal like? What went well? What didn't? Because you that was the thing that started your journey of now reaching over 100. So tell us
Yeah.
about that.
Well, it wasn't good. I didn't start out well. And this is kind of my story on everything, right? I mean, I started out as an active investor and some of it went well and some of it didn't. Same with passive investing. So what I first did is I was an active investor and I wanted to do something different. And I wasn't sure what that was. So I went to a syndication seminar, right, to learn about syndications, thinking I was going to be the syndicator. And I went to this seminar, and after about 5 minutes, they were talking about GPs and LPs, and I realized, oh, the LP, that's going to be me. That's what I like. And I had just converted an IRA to a self-directed IRA. So I had a bunch of money just burning a hole in my pocket that I wouldn't need for years and years. So I was pretty sure how these conferences worked, right? And if you're an operator and you go to a conference, that must mean you're just a great operator. Well, I learned later that you can just pay money and go to conferences. So I was very naive, but I figured everyone there must be screened and just must be the best. So I just went around saying, "Hey, I'm Jim. Here's some money. Can I invest in your deal?" And shocking, some of those deals weren't the greatest. Some were okay, but some were, I'm still dealing with those today. So that was not the best way to do it. But I learned a lot. And it's like, paying for a college education. Sometimes it's expensive, but you can really get some good education from failures. And I did. So some of those deals didn't pan out. Others were fine, but what it did was it taught me that I need to find a better way to find quality operators, right? And so then I went through that process and figured that out. But the first deal I did, I think, was a mobile home park in Alabama that is still in the gutter. It is a terrible investment. I haven't lost capital yet, but it's, I don't know, 7 or 8 years in, and I can't get the operator to communicate. We've fired one operator, hired another one, and it's just a disaster. I don't know if I'll get money back out of that one or not.
Yeah, I mean, while we're on it, I mean, tell us about that. I mean, I think one of the first things, I think everyone talks about is mobile home parks is an interesting niche because the supply of new mobile home parks is constrained and they're not,
Yes.
creating more of them. And so almost almost like a shoe-in, like there's a lot of demand for these assets, especially as we are going through tumultuous times and inflation keeps rising and the cost of living keeps going up. How uh, I mean, so many questions here. Like, what's that process like of firing an operator? Like, were you involved in hiring a new one? No.
Yeah, it's there isn't that much to the story because there's no communication. I didn't know the guy got fired. We just had a new manager that came in and took over the company. It's all very like, yes, mobile home parks, they should be great, but the problem is if you have a bad operator who can't get new homes into the park, then you have a bunch of empty lots that aren't generating any revenue. They're not able to get new homes in, and of course, they blame everything on COVID, even though the problem started before COVID, right? I have a few operators who are like, "Oh, COVID, okay." Yeah, but if your problem started in 2019, I gotta tell you, it's called COVID-19, but it didn't cause your problems. The operator just went dark, wouldn't answer emails, wouldn't take phone calls, and it was just one of those things. It was just sitting out there, a dead investment. And then somebody that worked for him said, "Oh yeah, he had these problems, and we bought him out, and so now I'm the operator, and I'll be better at communicating." And just terrible, terrible at communicating. And so it's just a disaster. He claims that he's starting to work and communicate better, but they aren't. So it's just one of those assets I have no idea. And it's just one of my early mistakes. I learned a lot from it on how to vet an operator because I did not do sufficient vetting. I just heard someone on a podcast or met him at the conference and thought, okay, mobile home parks, I've heard they're great, right? So that was a big mistake. But unfortunately, there isn't a story there because there is zero communication.
Out of like the 100 plus investments, right? Like there's no just like if you investing in anything, the likelihood of hitting batting 1,000 is near it's impossible. So, obvious I would imagine that earlier in your career there were more misses, but maybe there's some deals that went sideways with, COVID and rising interest rates and things like that.
Yeah.
What can an LP investor who's, I'm 23 deals into my 100 deal batting average, I guess. How many deals do you expect should go sideways and how many, have gone through yours? And were they, front weighted to the beginning? Are you expecting some to lose just every year? Out of 100, you should have 5 or 10 miss.
Yeah, I didn't expect any to miss. I really didn't. Now, the early ones that missed made sense to me, right? Like this one that I was talking about, the mobile home park. I don't know if I'm going to lose money on it or not, but I've certainly the opportunity cost of having that investment and that money sitting out there that long, it wasn't worth it. The other early misses are some of the like I didn't know what I was doing, so I invested in a development deal that's just gone on and on and on. So maybe that'll pay out, maybe not. But most of the misses came from the interest rate difficulties, right? Because there was some operators who were doing great. They were basically flipping apartments, right? Where they'd have a 5-year pro forma and they would double the value in 18 months, give you your capital back, and you'd be like, yeah, let's roll it right back in. And so those are the ones where I knew those were risky. I knew the business plan was risky if interest rates went up. But the upper, their thing was, well, we can pivot. If interest rates go up, we can pivot to a different business plan. Well, interest rates went up faster than anyone could have imagined. And so that caught a lot of people off guard. And some of those deals, Yeah, those are the big losers. And there's been several of them. Now some of them got rescued, some of them are fine, but that's the whole point of being a passive investor to me rather than active. The benefit is diversification. I diversify by operator, by market, by asset class. So one operator going bad is not going to pull me down. Now I overweighted on a few operators, and those are some of the, I've learned a lot of lessons. And as I said, you learn from your failures. So I way overweighted one operator and I got great results at the beginning, and now I'm paying for it. But overall, with that operator, I'll probably be up at the end of the day, but it hurts to lose that money along the way. And so what I've learned is you got to keep diversifying. You got to not go all in with one operator. And certainly when you meet a new operator, don't go, take your time, patience. I think one of the keys, I think the two keys to being a passive investor, successful syndication investor, the two keys are patience and community, right? If you're patient and you have people you could talk to about this, your chances of success go way up.
Yeah, talk a little bit more about that. I mean, I imagine that's what led you to start Left Field Investors, which has now been bought and turned into Passive Pockets. Talk a little bit more about maybe what led you start that, and maybe some tangible stories that have come out from community.
Yeah, so it's I was a BiggerPockets member, and when I was an active investor, and they always said, "Hey, if you don't have a good meetup in your area, then start one." And so I did as an active investor, and it's still an active community that or group that meets today. I don't go anymore, but it's still going. And the success of that and the partnerships I made and the deals that I got done through that group and the friends I made, I thought, hey, when I transition to syndications, I'm going to start a mastermind. There's going to be 12 people, have dinner once a month, and that was it. Well, our first meeting was March 18th, 2000, which, if you think back, that's when COVID shut everything down. So we had to go on this new technology called Zoom, and that's how the community started, because then it could grow, right? I kept the first year, I just kept trying to keep it small. So we had 50 people, but there was so much interest that it just blew up and became a pretty large community. But what I realized was that for this type of investing, a community is critical because these are long-term, illiquid investments that are completely out of your control, right? And they're hidden, as we talked about. It's hard to find them, and it's really hard to find information. And so I can't test out an operator by investing in them and then waiting 5, 6, or 7 years before I make my second investment, right? I have capital to allocate. That's not realistic. So what do? Is I rely on other people, my community. And so when I look for a new operator, I only invest in new operators if they're referred to me by someone in my community who I know, like, and trust, who's already invested with them. Doesn't mean they've gone full cycle, but maybe they've been at least a year with that new operator. And so I still do all my same due diligence, but that puts me steps ahead, right? Because someone else already knows, oh, I send the wire and it actually gets there. They do the reports, they send out reports like they said. The distributions are coming like they said, or not. And I asked questions why, and they said this is why, right? So all these things you can confirm, which there's no other way to confirm that, right? You can just take the word of the operator, or you can get actual data. And some of the things you said results is we have reviews, sponsor reviews on the Passive Pockets website. And those have saved people who've gone on and, type the name of the operator they're looking into, and they go and, man, they have all 1-star reviews. Well, okay, let's dig in. Why would I want to invest with someone who people think are 1-star? We have also a page that's red flag sponsors, right? That sponsors that have had difficulties for this or that reason. And people, just like you'd go into Google, right? Instead, they go to Passive Pockets and they type in their operator and they're like, oh, it's on the red flag sponsor list. Let's see and check out what that is. And it stopped people from investing because there are some operators out there who have completely lost investor capital and change the name of their company or not, and go out and raise more capital from unsuspecting LPs. Well, if you're in a community, that's not going to happen to you because everyone's talking about these operators in our forum and other places and sharing information. So yeah, we have definite examples of people who are ready to send a wire and just asked a question in the forum and then said, oh, wait a second, I'm going to, review that and see if I really want to do that based on other people's experience.
I definitely resonate with that. I feel like there's a big part of my process is also just calling previous or existing investors, seeing who's in their deals. how has the communication been? But yeah, I know exactly what you're talking about. I've done that, and I've not invested in operators because of looking at least one particular operator for that. So I think that makes a lot of sense. Take a quick second for all of those who are listening live. And thanks so much for joining us. I'm seeing a lot of chatter in the chat. If you have questions as we're having a talk here with Jim, don't hesitate to put them in the chat. We'd love to hear you. And if you're following on online, leave a comment if you're watching this after the show. So, Jim, I'd love to maybe kind of dive into, what do you think most LPs get wrong when they try to go it alone?
I think you're just limiting your options, right? Because what I found, even when we started Left Field Investors, we knew about, I'm making up the numbers, but we knew about 10 operators, right? When we had the 12 people. And then 3 more people came, and then we knew about 6 more operators. And so it just expands the base of knowledge, right? And it's incredible. I remember the first person, he's one of the founders of Left Field Investors, Steve Sue. When I first met him, and he said, "Hey, yeah, I'm doing this syndication stuff. I invested with ABC Operator." And I was like, "Me too." And then he said, "Yeah, I'm in this deal." And I said, "Me too." And I was like, I just couldn't let go of him because I found someone, a smart doctor, who was investing in the same stuff I was. And it just felt like a lifeline, right? Like, okay, this is because the first time I sent money, I was like, all right, I'm going to send a small check. I could still feed the kids if this goes wrong, but this has to be a scam, right? Because you're thinking everything's a scam. Well, if you go it all on your own, you're going to get caught up in that stuff. It's just really hard to do this by yourself. And so I don't know what you would do if you didn't have a community or a network or at least somebody else to talk to about this. I mean, that's why you have people coming onto this live call to listen, because they're like, oh, I want to hear about these operators. I don't want to hear about these other deals, because that's how we learn. And there's no morning star, right? You can't call up Tim Cook and say, hey, how's things going at Apple, right? But you can with these operators, but you can also call up your buddy who just talked to him, right? You don't know anybody who knows Tim Cook, but you might know somebody who knows your operator. And so it's just about, the community is a network. And if you don't have that, you're just going to be struggling because of the unique way that syndications are structured, that they're long-term, they're hidden. All those reasons make it very hard to do this on your own.
How has your due diligence process evolved over time? Like right now, we're talking about one aspect of due diligence, which is, getting feedback from other people, talking about talking with your community about operators and deals. And that certainly adds color. What does your process look like when you're looking at deals?
Well, I first start with the operator, as I said, right? And so then we qualify the operator. And there's a couple of things I do that are kind of evaluating a deal, but more evaluating the operator, right? So once someone says, hey, check out this operator, then I'll call them up, ask them questions, say, hey, send me a deal, right? They'll send me a deal. And I know I'm not investing in the first deal. There's just no chance of that. But I look at it, I evaluate it, because we have like a deal analyzer at Passive Pockets where you can put in the data in Excel spreadsheet. It doesn't tell you whether it's a good or bad deal, but it kind of just puts up a bunch of red flags that give me questions. And so I'll come up with a list of questions and I'll email it to the operator. And this is just a test. I want to see how quickly they respond, right? Within 24 hours, or have a reason why not. And I want to see the quality of their answers. If they say, oh, Jim, all that stuff was answered in the webinar, my response will be, yes, I know. I've watched the webinar. I want to know that you know your deal and will interact with me on it. And then, so they'll hopefully reply with questions rather than watch the webinar. And if they do, even if they've answered every question, I will then send another email with more questions, even if I don't have any questions, because I want them to know that I might be a little bit high maintenance. And how are you going to deal with someone who wants to know what's happening with their deal? And, if they're the kind of person that says, hey, can I just call you up and chat about the deal? Fantastic. Or if they answer the questions, I mean, most good operators will thank me and say, oh, this is great. I'm so glad you're so interested, right? But others, they blow me off, or they don't give me answers, or they're squirrely, or it takes a long time. That's easy, right? Because the only thing you have once you send that wire is communication. You have nothing else. This is completely out of your control. So if they're not going to communicate with you before you send the wire, what do you think they're going to do once they have your money, right? They're not going to communicate. And I don't care if the deal's going great or terrible. If you're not communicating with me and telling me how it's going, I'm stressed out. And I'm not in this to be stressed out. So that's kind of one of the things I do, right? qualify the operator. But you asked about the deal. So when it gets down to the deal, like I said, I put it through this analyzer, and you do that enough times and you kind of come up with a few metrics that you're really interested in, right? The things that you could look for just to kind of proof it. Because if I've taken this much time to vet the operator and I trust them and I think they know what they're doing, I am not going to take their pitch deck and re-underwrite the deal like I'm buying the property myself. That is not what I do as a passive investor, right? I'm going to trust you that you did all the work, you know what you're doing, but I'm going to spot check you. So I'm going to dig into the financials and look at what your proposed rent increases are. Are those realistic? If you say you're going to increase rent 7% in year one, I'm probably going to ask you about that because that doesn't make any sense, right? Because they don't all renew on the first day, right? So that's not realistic. Or if there's I look at the taxes. If the year one taxes are the same as the ingoing tax or the P12 tax, I'm like, well, probably you're going to get a tax increase because the property just changed hands. So I'm going to question that. Or if you say economic vacancy is 5, I know I'm getting into the weeds here, but
No,
I'm going to
this is
question.
exactly what I want.
Okay, well, I'm going to question that because you know what? That's what I thought vacancy was when I was an active investor, 5%. But vacancy and economic vacancy are different, right? There's all kinds of other factors in economic vacancy, like loss to lease and concessions and other things, bad debt. And so if it's just 5%, I want to see, is that realistic for the market or the asset class, right? So you find some little things you can hone in on. And if all those check and there's no other red flags, I'm like, okay, this person probably knows what they're doing. And, I'll maybe invest in the next one that comes up because I'm not investing in the first deal you send me. So that's kind of how I analyze deals. Now, the nice thing about, again, I'm back to community, I'm a broken record, is we have some people in our community who ask for all of the financials and underwrite the deal like they're going to buy it because that's their expertise and where they came from. We have others who just say, you know what? I trust this operator and I'm just going to look at tiny little things and just concentrate on vetting the operator and everything in between. And that's the beauty of community because we kind of turn community into a verb, right? We community the operator, which means we all talk about the operator and ask questions. And we do the same thing with the deal. Hey, did you see this in that deal? We do deal reviews at Passive Pockets where we'll get 3 experienced LPs and we'll have an operator on and they'll pitch their deal. Then we'll ask them questions, the toughest questions we can figure out how to ask. Then we'll say goodbye to the operator. And then the 3 of us will talk about the deal, the good, the bad, the questions, additional questions we would ask. And then we'll say, hey, would you allocate capital to this deal if you had it and why? And so you get to see 3 different perspectives on that deal and the questions people ask. And that's why community is so valuable.
I might have misheard you or misunderstood. You mentioned that one of the first things you do is hop on the phone with the operator, even before kind of reviewing the deal. Do I have that right?
Yeah, I do. I try if it's a new operator, I just get on a call and just I have a notebook and start asking questions.
So let's talk through that a little bit because if I spent half an hour with every single operator that reached out, I yeah, I wouldn't have the time. I mean, literally, I probably have 4 or 5 different operators reach out to me a day. And the first thing everyone wants to do is hop on a call. And to me, the way I approach it is I say, hey, look, I appreciate the willingness to hop on a call, but, can you send me a deal first? Like, no point in me spinning my wheels or us having a conversation if I don't even know if your deal is remotely in the vicinity of what I'm looking
Yeah.
for in my buy box. So are you maybe like just keeping that kind of inherently in mind and you didn't mention it, or are you going out and trying to meet all the operators and just understand the space a little?
Well, so when I first started, right, this was my full-time job. I was going to be a full-time LP before we started Left Field Investors and all of that. And at first I was like, I'm not going to talk to all these operators. And then I'm like, this is my full-time job. If it takes me a half hour, an hour, I could do 4 or 5 of those a week. Right. But that was then. Now it's different. I've learned a lot. And no, I don't talk to every operator that asks me for a phone call. I only talk to the ones that I think I might actually be investing in. So yeah, when someone reaches out, I do that. I say, send me a deal. Right. And then I go to my community. Hey, does anybody know this person? If nobody knows them, then, I might ask them for 3 or 4 deals. And then if it's interesting, maybe I'll get on a call after that. But I'm super reluctant to invest with anybody who doesn't have a connection right? That knows them, right? So I'm super hesitant. Although in the beginning, when I didn't know what I was doing, I met a couple of really quality operators just cold calling, right? So I don't want to totally eliminate that. But my general process is if you're recommended to me by somebody, yeah, I'll get on the phone and I'll have that conversation. If not, if I just find you on LinkedIn or you find me, then I'll say, hey, let's share a couple of deals with me and I'll look at them. And then we'll decide if it makes sense to get on a phone call or not. But I don't call every operator and spend 30 minutes on the phone with them anymore because I have a better system now, which is just learning what other people are doing and using other people's knowledge.
How is your process, or how is has the asset classes you've invested in changed over time, or has it been relatively consistent? And maybe I guess before answering that is maybe give us a highlight of the breadth of asset classes you've participated in.
All of them. I chase the shiny object and I try to stop myself. That's why patience, right? Patience. I think one of the two great things I've learned is, JOMO, and that was the ninja, the cash flow ninja, MC Laubscher, right? He calls it JOMO, the joy of missing out, right? Where I can look at a deal or a new asset class and be happy that I'm just going to let it pass, right? So that because I like to just try everything new. So that's one thing. The other thing is what we call the Shirky rule. There's a guy, David Shirky, who's one of the original LFI members, and he has a rule that he's not going to invest money a second deal or recommend somebody to anybody unless he's been invested with them for at least a year. So he can like check them out. Because some of the things that I meet someone and I'm like, oh, I love this. And then I invest in 5 deals in a year, and then I find out they're not who they say they are. Right. So those are some of the things that I try to do. But that isn't really the answer to your question. Those are things that I try to restrict myself from chasing the shiny object because I do like looking at new asset classes. So as I said earlier, I think I diversify by asset class, right? That's one of the ways I diversify. So I do try to get into a lot of asset classes, but I'm trying to be a little bit more careful, not just jumping into everything that comes by. I think the gateway for almost everybody is multifamily, right? Almost everyone's lived in an apartment and certainly at least in a house. So people understand multifamily. So it's easy to jump in there and there's a ton of it out there. But once you kind of get in there, then you find, ooh, there's self-storage, there's mobile homes. Those are kind of similar. And then all of a sudden you're in car washes and RV parks and you're like, how did I get here? Right. But every one of those, there might be a place for those different asset classes. So I definitely try to diversify by asset class for sure.
Do you have a anything you're keen on right now as we, go through the rest of 2025 and the next several years? Some of the things I think about are we have this wave of the baby boomers, aging into retirement homes, and is now one of the best times to be getting into assisted living, or has that window passed? There are a couple different trends that have become popular, or at least more popular to me, which have been car washes and things in my eyes. I think about, okay, is this a trend? Like, is it really, performing this well? I've been to a seminar around car washes. I've actually visited an operating facility, I think it was Johnny's Express Car Wash. As I was looking into potentially doing that investment, are there things that you're looking for at this time, or are you sticking to multifamily and a couple of your tried and true asset classes?
Well, so liquidity is an issue for me because that was one of my big mistakes, right? Initially, when everything was turning over in 2 years, I thought, who cares about liquidity? Well, now things are turning over in 7. So guess what? I don't have a lot of liquidity. But when I do have liquidity right now, I am being cautious, and debt is super popular right now and it's paying off. So, there's a lot of the different types of debt funds. So I'm interested in those and other things that I'm looking at industrial with all. I mean, it's chaos right now with, the Trump's tariffs going back, they're on, they're off, they're on, they're off. So that's complicated, but there's no doubt that there is some reshoring happening post COVID. And so industrial's been booming. So is it still going to boom? I'm not sure, but I'm keeping my eye on it. Multifamily, I think the next few years, we talked about this. I think the next few years are going to be good in multifamily because you can forecast it out a little bit based on new inventory coming online, right? And we had a bunch of it over the last year or two, and we have a little bit more this year, and then it drops off a cliff over the next couple of years. So we know that there's going to be people that need places to live, and so apartments look like over the next couple of years could be a good bet. We just have to get some of this inventory moving, right? The deals that are stalled because of interest rates and those other problems. So I like to diversify by asset class. Right now, I'm mostly looking at debt, but I am open to anything, and it's really going to be operator specific. There's a few operators out there who I think really do a good job, and I'm watching them when they have a deal, my ears perk up.
You've mentioned this thing online recently. In my snooping and my following of Jim online, you've mentioned this common saying of "Don't be someone else's guinea pig."
Yes.
And
God.
so, I wholeheartedly agree with that, right? And I think I may take it to more of an extreme as I'm finding out in these calls, and I'd love to get your take. I think of, first off, someone's got to have a great track record doing all these projects on their own. Someone that's worked at a firm and then has left the firm and is starting their own, doing maybe the same asset class, doesn't quite mean that they're experienced in my eyes. They're maybe a new money manager, even though they might have done the strategy, a lot of times they might have had a lot of different support, a lot of different team members. And so those are hurdles that I have. I don't invest in anyone that I consider new like that. I like to go more towards an institutional type operator, people who have over 100 million under management, who have already gone through the quote unquote scaling phase of maybe having 10 million in assets under management to going to 100. There's so many things that break and change, and new people you need to hire, and managers, and things that need to come in place that I personally believe that a lot of people don't appreciate. But maybe that's contrarian. Tell me how you think about, or what do you mean by don't be someone else's guinea pig?
Well, so the first that's one of the biggest lessons I learned, right? Is there was this operator who was doing turnkey single family homes in Dallas and was just crushing it. And the Dallas market changed, right? It made it so it was very difficult to be successful at turnkey anymore. So they decided they were going to do like the strip mall office, not big office, but just office and in strip malls or whatever. And I thought at the time, well, they were great at single family turnkey. So, I mean, it's real estate. It's all the same. So I invested. I actually got my dad to invest and my mom, or not my mom, my dad and my sister to invest. So my whole family invested, and it went poorly, right? And we lost money because they did not know what they were doing. And that's when I realized, okay, that doesn't necessarily transfer. So I am not going to be someone's guinea pig. What I should have done is let them go do it, watch a couple of deals, and once they've proven that they could be successful at it, then I go in, right? And so what I try to do now, and it's complicated for a couple of reasons, right? So let's say you're a big multifamily operator, right? We all know them, and all of a sudden they're doing multifamily, and then they say, "Hey, I'm going to do self storage." Okay, well, you're a big operation. You have 100 million assets under management or whatever. You're probably going to be successful at that, right? But I'm not going to be your guinea pig. I'm going to make sure that you know what you're doing. So now you tell me, okay, well, we hired someone who has 20 years experience in self storage and he's going to run this operation. Okay, still not going to be your guinea pig. I'm going to watch your first fund or your first couple deals and see if they're successful. And then, okay, then I'll be in, right? So it's the same when someone says, "Hey, I'm going to be Phoenix market. I'm only Phoenix market," right? And then they go to Dallas or they go somewhere else. Then, okay, I'm going to watch your first few deals there and make sure that you're doing it right, or you have the resources, you know what you're doing, right? So there's different ways to look at it, but I am not going to jump in and be your guinea pig. And it's really, really hard because there's a couple operators who I think are fantastic, good people, completely trustworthy, been in the industry for 30 years, know exactly what they're doing. And I just am dying for their next deal, right? But their next deal now isn't a new asset class because the old asset class isn't working because whatever, it's multifamily and it's hard now. And so they're doing something different. I really want to invest in this because it's an asset class I really like. It's a person that I really like and trust, but I have to have patience, right? I have to talk to others in my community and I have to remember my rule. Don't be someone's guinea pig, because if they're super successful in this, guess what? They're going to keep doing it. And I can jump in on the second one or the third one. I don't have to be the first mover. So, no, I am not going to be your guinea pig, but it is complicated with trusted operators. With people I don't know very well or things like that, that's easy. If you're doing something new, I have no interest.
Do you have like a minimum of assets under management or number of deals done or deals that have gone full cycle? Is that a requirement for you?
It's not. I ask those things and I look into those things, but sometimes there's new people that are really good, right? And I don't want to miss out, but I'll be very cautious. I'll see what their other experience is. I'm not going to invest in a, no offense, 19-year-olds out there, but a 19-year-old who's buying an apartment complex, that'll be a definite no, right? But if you've done, worked at, I don't know, being an apartment manager for 20 years and now you want to syndicate a deal and you have all this experience and you have a good game plan and you have good solid partners and you check all the boxes and I've met you and other people have recommended you, I might think about it. And one of the things is because that's my personality is I want the new thing. I want a shiny object. That's a great way to invest in a group, right? We use TribeVest to invest in groups. And so there's some, I have the over 100 investments. Well, some of them I only have $5,000 in because I'm in a group with 5 people and we invested $25,000 because it's a trial, right? We're testing things out. We tested out some new asset classes. We tested out some new operators and we did it with smaller chunks. And so that's another way that I do that because I can't stop myself from wanting to invest in these new things. So I find a way to do it in a way that won't crush me, if it goes wrong.
Interesting. So you're actually, is that like a de facto strategy? Like anything new, you're doing that way? That's actually a really fascinating way to get your feet wet.
Yeah, it's not. I mean, it's been harder to do that lately. I mean, that was like in the height of the market when everything was going gangbusters. It was easier to do that. Now people have become more cautious. But absolutely, if there's something I'm not sure about, like on the deal review series, we talk about that. Like, would I put my own capital in this? Probably not, because it seems like a good deal, but there's a couple of things I have questions about. Would I put $2,500 in with a group of 10 people in a LLC? Yeah, I'd take a flyer on that because I want to test these guys out. And that's one of the hard things about this type of investing is you always have to take such a big swing. I mean, no matter who you are, 50 grand is a lot of money. And so if you could find ways to take smaller swings and still test these things out, then I'm all for it. And so I've done that. It's harder now, but yeah, that's something I like to do.
Yeah. So we talked a little bit about, in previous years it was gangbusters and that it might be a little bit more difficult in today's environment for operators to raise capital or for even maybe LPs, who are struggling in past deals. But I think something that you've talked about before, which I'd love for you to elaborate on, is how this actually might be one of the easiest times for LPs to figure out who they want to work with. Tell us more.
Yeah. Yeah, I've gotten a little pushback from people, but I'm getting more confident in this, right? Because think about the questions we used to ask, right, before all the troubles. I don't know what they're going to call this time, but the interest rate difficulties, right? I used to always ask, "Have you had a capital call?" And I never got anyone to say yes. But if they had said yes, I'd be done. I'd be like, "Thank you for the call. See you later." Right? Because why would you have a capital call when everything's just going up? Well, now there's been so many people that have come through difficult times. So if you've had a capital call, that doesn't mean a no for me. It means more questions. So you had a capital call. How much lead time did you give? Did you send a report on April 1st saying everything was awesome and then April 3rd you sent a capital call? Okay, that's different than if you've been telling me for 18 months a capital call might be around the corner, but we're trying to avoid it. And then when you did send the capital call, did you just say, "Hey, you need to contribute 20%?" Or did you act like it was a new investment and send me a full pro forma explaining exactly how you're going to use the money? What's the new business plan? Why did you need it? All this stuff. Those are different conversations, right? So now I think it's going to be a lot easier because it's going to be easy to see, oh, you handled these capital calls poorly, or maybe you didn't have a capital call, but how did you handle this when interest rates went up so far so fast? What did you do? How did you get through it? Did your deals survive? And it's not as important to me whether the deal survived or not. I would prefer them to have survived, right? But if they didn't, it's how did you handle that adversity? Because if you came through shining and you have investors who are saying, you know what, I lost equity with this guy, but I would invest with him again. I mean, that's bells going off, right? You lost money and you do it again. Why? There's got to be something special about this operator. And then someone who got through the difficulties and still made you money, well, that's even a bigger endorsement, right? So now we're going to be able to differentiate between operators a lot more easily than we could before. And this again, broken record where community comes in because I haven't invested with all these different operators, but now I know someone who invested with XYZ operator through the difficult times and I can say, "How did it go? Did you have troubles? How did they get through it?" And they can explain it a lot better to me than the operator can. So I think that, vetting operators, it's never going to be easy, but it's certainly become more easy because now it's not just everybody has 20% IRRs and, has done awesome. It's, man, we've all been through it. How'd you do it? Explain to me. Now when 5 years ago, if I said, what's the toughest deal? What deal did you have that didn't go well? Crickets. Oh, well, I had one that had 19% IRR, not 20. Ooh, that must have been tough, right? But now you ask that question, I mean, they're going to have a story to tell. And that's where you get the information. You get their story and then you get it from some of their investors that you know. And so I just think it's going to be a lot, it's not going to be easy, but it's good. You're going to have a lot more data to evaluate when you're vetting an operator and a lot better questions you can ask. How did you get through this time?
You're also going to know how forthright they are, how transparent they are. Yeah.
Yeah. Yeah, if they say, "Oh, nothing happened, it was fine, everything was perfect," then okay, well, see you later. I don't believe you, and I'm moving on.
Why, let's talk about that capital call again for a minute. So I think, one perspective is that if a firm has gone through the process of a capital call or they completely wiped out investor equity, that they didn't read the scenario right. They didn't, they got variable debt instead of fixed rate debt. Yeah.
But, I
How
mean,
do you think about that?
did you read the scenario right? I didn't.
Yeah. If you invested, then
Right?
yeah.
I didn't know. I mean, I thought interest rates might go up. If they were out there saying, "No, no, interest rates will never go up and it's fine." That's different than saying, "Yeah, I expected interest rates to go up, but I didn't expect them to go up 20x in 18 months." Because no one expected that because that's never happened before. So I have to give some grace to someone who is like, you know what? Like the one operator I was talking about, right? I went and I knew they were flipping apartments and I knew that if interest rates went up on this, their debt was going to have a struggle and they knew it, but that was the business plan. I signed on to that. So I can't get mad at them for not performing because of that. Now, there's other reasons I can get mad at this particular operator. They're arrogant. They didn't admit things. They said, "Oh, there's only 2 deals that had trouble, and then there was 4, and then the next week there was 12." And they just really handled it poorly. And they're some of the deals that they invested in 2009 trouble, and those should have already been value added out of what could have been trouble. So there are all kinds of other issues. But I can't be upset with them that they didn't know interest rates were going to 20x in 18 months. So that's how I look at it. I'm not happy that they lost money. And if someone lost investor equity, it might be unlikely that I would invest with them, but I'm not going to shut them down just because of that. I want to hear what they learned and how they're going to do it differently next time. Now, if all the investors I talked to are like, "Oh, they handled it poorly and it was terrible," that's different. But not knowing that interest rates were going to go up so far so fast is not, or not knowing that insurance rates were going to skyrocket. Those aren't things that can be predicted, right? They call it black swan events or whatever. Maybe we just had a bunch of them at once. I'm not happy about it. And yeah, I would have loved to have fixed rate debt through all that time. But guess what? I made a lot of money from operators that had bridge debt because they were flipping their properties really quickly. And if they had had fixed rate debt, I wouldn't have made that money because they wouldn't have been able to get out of those loans without paying big penalties. So you can't have it both ways. So I mean, I'm going to avoid a lot of those operators that messed up, but most of it's going to be because of how they reacted and didn't react and what they did wrong then, not the fact that they had bridge debt. I knew it, they knew it, and I gave them money, and now I'm mad at them because bridge debt didn't work out. That doesn't seem right.
So it's more. I think what I'm hearing from you is more of a mindset of like, as LPs need to take more ownership if we are in deals that went sideways because we also didn't look at that factor. I think, I don't know if I have a clear opinion on it, but, I do know that there is this idea that many operators need to do deals in order to earn money from fees in order to be able to support their staff. And there are
Yes.
many operators that have stayed on the sidelines or maybe done a deal in the last several years who, haven't run into these troubles. And there are those that, kind of needed to make deals happen. And so, I've mixed feelings about
Well, that you
this
ju
idea. I think it's easy to get lured, and I think the ultimate response is like I am the investor and I made the decision to wire them monies. If anything, I am the most at fault. I mean, that's that's actually the
well, it's
only
all
reasonable way to approach
right.
this because it's your life, right? Your money. No one will handle your money better than you. You can blame the operator for luring you in, but it's still your fault.
It's all a range, right? Because if someone was dishonest or was just investing or just putting out a new deal because they needed the acquisition fee to pay for their past deals, that's stuff that we need to figure out, and that's on them. I would blame them, and I wouldn't do a deal with them again if I found out that's what happened. Or, if they weren't honest about the debt that they had on the deal, or they didn't explain things right, or they were all those things. There's some fraud that's been going on. There's people that have, are hiding from their bad deals and putting out, new deals and not being truthful about their record. All of those things are automatic disqualifiers. I think that you have to take each operator and look at them separately and really try to figure out what went wrong and why, and then decide, do I want to move forward with this person or not? I mean, yeah, I take some responsibility, but even the operator that had the best capital call ever, I'm going to think twice about whether I want to do another deal with them because, I'm potentially going to lose money, and it might not be their fault. It might not be my fault, but it's still money that is lost or potentially. And so I think I'm trying not to be too broad about any of this. If you were dishonest or even deceptive and those kind of things, that's an automatic disqualifier. But if you just had trouble and you were honest about it and open and transparent the whole time, then, I can't, I mean, I'm going to be upset that I lost money, but I'm not going to be like, okay, you're a terrible person. I'm never going to invest with you again. Right. I think it's a hard thing, but there's shades, right?
Yeah. Yeah, I think Jim's a little bit more lenient than I think I would be. What are I think are there more red flags that you're sensitive to now than when you started?
But yeah, I mean, I look a lot closer at the debt, and, I don't think I really fully understood that bridge debt of 3 years with two 1 year additional extensions that you had to pay for and may or may not come true. I didn't really understand that as well as I should have. And so, now I'm looking at those things a lot closer because as Brian Burke said, and I think Jay Scott said it too, is, over any 10-year period in history, real estate's going to be okay, right? But if you have 3-year debt, you might be sunk, and you are. So there's things like that that I'm a lot more cautious about when I hear bridge debt now. People are like, oh, interest rates are, now's the time for bridge debt. I'm like, okay, I've been burned by this before, so I'm not super confident. So I'm just, I find different ways to diversify. Now, if I don't know that I do a bridge debt deal, but if I do a bridge debt deal now, I'll probably do 3 fixed rate deals alongside it just to diversify. I don't know. I've learned a lot, and I think the main thing that I learned is patience. Allocate your capital slowly, diversify, and use your community. I mean, those are the 3 things that I've learned. Because there's some things where, like, I don't know if you're into the ATMs and stuff, but I people lost a lot of money, and I'm trying to figure out what can I have learned from that. That investment paid out for 10 years, like clockwork. I made a lot of money on ATMs,
I was
right?
in it too. I also made a
Yeah,
bunch of
and
money.
and then it didn't. And then it didn't make money. Well, what happened? Well, the one thing I've learned is there's a capital raiser, and then there was a company below it and a company below that. I don't think that I knew there was that many layers. That's on me. I should have figured out there's that many layers, but even had I known that, there was fraud way underneath there. So what's the learning there? is I'm probably going to do fewer deals that have that many layers of management because the top person isn't going to know what the bottom people are doing. But that's not a real quality lesson. Like, okay, right? I mean, just sometimes you can't beat fraud, and that sucks. But the
Yeah, I
fewer
mean,
layers and the closer you get to the operator, the less you're going to have that, I think.
yeah, I mean, I even just think about like there are several companies on the stock market, like you can look at Enron, publicly traded companies. I think you do enough investing and you will run into that. And I think yeah, that's just one way I look at that. Jim spitting wisdom. Jim, this has been incredible to have you on the show today.
It's been fun.
And yeah, I've really enjoyed it. The guests, I'm seeing a lot of people in the chat. They've been commenting as well. If you're listening to this later, let us know what you took away from this. But Jim, where can people go find you online and learn more about you?
PassivePockets.com. We have a 7-day free trial. You can join our community and you can DM me on there, or you can come to Columbus on May 2nd, May 3rd. We're having the Passive Pockets Summit. So for those that are listening live, I don't know when this is released, but love to see you there. And I'm also on LinkedIn, and I love chatting with investors. So just connect with me and let's talk limited partner syndication investing. That's what I do.
Love it. Okay, so for those of you listening, if you love this show, make sure to join us every Thursday for more actionable strategies on the Passive Income Playbook here on the Best Ever CRE Show. If you love these episodes, please subscribe, leave us a review. Your feedback definitely helps us continue to provide valuable content and reach more investors like you. And with that said, thanks for tuning in, and we'll see you next week for another episode of the Passive Income Playbook.